I want to do simple things to make money.
Why the hell did you move to trade in emerging markets?
The choice to go to emerging markets was reflecting how efficient the US market has become, how much the traditional factors have stopped working in the US, and also a statement about how inefficient emerging markets continue to be and the alpha potential there.
So it sounds almost like you were squeezed out of the US market.
As a quantitative data scientist, I've seen in data anytime a country is uninvestable, are there really cheap assets to be had because of the geopolitical conflict?
It's like a no-brainer to buy
yeah.
them. And you're not sympathizing, you're just making money. How big is the AI in your portfolio? Is the big part?
Yeah.
So if it happens to be a bubble,
When the bubble bursts, you're gonna have to ride down with it, but you also don't want to miss a 30-year super cycle as well.
hello and welcome. It's Capital Horizons. I'm Igor Yelnik. My guest today is Jason Su, founder and CIO of Reliant Global Advisors. Hello, Jason. Thank you very much for joining me.
Hello, Igor. It's good to be back on.
Today we're going to speak about emerging markets. You trade emerging markets. This is the core of your business. And before that, you were doing very successfully fundamental indices, working with Rob Arnott, co-founding research affiliates. It was a very successful career. Why the hell did you move to trade in emerging markets?
Well, Igor, the thing with market efficiency is the harder you work at it, the more markets become efficient, and then the less you produce given the effort, right? So I started my career working largely in US large cap equities, right? The bulk of the fundamental index assets, about 90% of the 150 billion that I raised were in US large cap. And that's a really efficient market. And it was also a very efficient market that's gone from one where value stocks could outperform to where growth stocks were actually priced cheaply and were the ones that continued to outperform. And so the value premium stopped working in US large cap. And so I had to look to markets where there's still very high degree of inefficiencies, where the growth stocks tend to be more sex and jazz rather than companies with true growth potentials. And the value stocks tend to be those that are underappreciated and really could give phenomenal returns to investors. So the choice to go to emerging markets was reflecting how efficient the US market has become, how much the traditional factors have stopped working in the US, and also a statement about how inefficient emerging markets continues to be and the alpha reservoir and the alpha potential there.
Okay, so it sounds almost like you were squeezed out of the US market. So how do you treat emerging markets then?
Well, a lot of people like to do really smart, really hard things to prove themselves. I'm probably a little lazier. I want to do simple things to make money. And in emerging markets, you could use a lot of the same techniques that have worked really well in the US. You deploy that to Taiwan, to Korea, to mainland China, to India, to Latin. And those very same factors, those techniques continue to generate a reliable and a much larger size of alpha. And so that's what I mean by you do kind of the easy stuff, but just in markets where they work and can produce a return for your investors.
Indeed, but the risks are very different in those markets, right? It's not just big versus small or growth versus value.
Absolutely not.
You also have to take into account a lot of other things. How do you do that?
Yeah. So in those markets, first of all, it's not just the simple traditional kind of Chicago style large cap versus small cap, value versus growth. I mean, those work in those markets, absolutely. But it's all the other factors, right? We use about 200 plus factors. Some are macro oriented, a lot of are behavioral oriented. You have to localize and customize to both data availability, to the differences in accounting structure. So there's actually quite a bit of work to be done, but at least those work pay off, right? Like you can do a lot of work in the US and the markets a step ahead of you. The market's pretty efficient. You're competing with people just as smart as you are, and so you do a lot of work and there's no payout. But emerging markets, there's still a lot of hard work. I'm not saying there's no hard work, right? It's just like you actually get paid for doing the hard work. You actually get paid for thinking about it, localizing, customizing. And so, you do want to go where your human capital and where your intellectual capital pays. But you're right that there's a lot of sort of secret sauce and hard work that's required.
Okay, give us a little bit of the sauce. How do you decide which risks are compensated and which are not?
Well, so the beauty of a quantitative approach, right? The quantitative approach is, of course, not the end all and be all, but it does have one tremendous advantage, which is you have a lot of historical data, both historical data from emerging markets, but also other developed markets, which earlier on were more inefficient. So they have a sense of, emerging like in the older part of the data set. So you have a lot of data, right? And with data, you can apply your methodology and say, if I was to do this, honestly, what would I have experienced, or how big should the drawdown be, given the degree of tracking here I'm willing to take? How much can I get paid on average? And that back testing gives you a sense of what strategy, what style, what risk is likely to pay what, and also just the correlation of these risks, the fat tails of the different risks. So having a back test, an honest back test engine, an honest back testing environment allows you to answer those questions quite scientifically and quantitatively.
Does it? Like, if you look at the US, let's say after the World War II, or Europe after World War II, we had a long period of geopolitical stability, well, a relative geopolitical stability. The US never had a war in its territory. Western Europe didn't have a war in its territory since 1945, with the exception of Yugoslavia in the late 90s. So if you look at those relatively calm times, you can't really deduce the geopolitical risks which may affect the markets today.
Igor, you're absolutely right. Like, so part of being a good data scientist is to know that whenever you're using data to try to tell you something about the future, you have to be super careful, right? Because the underlying assumption that historical data is of any use whatsoever is the assumption of a stability in the data, meaning the distribution, the data structure in the past is representative data structure in the future. Clearly, historical data and future data are only going to share some similarity, some common characteristics, and there's going to be a lot of it that is just, sort of irrelevant. And so being a good data scientist, you got to figure out how to cut up the data so that you're only focusing on the part that has a high probability of repeating, and then
Mhm.
focusing on patterns you can get there. And then you got to sort of throw out the stuff that don't repeat. And so, like you say, right, like anything that is about some major episodes in the past, strategies that'll help you time, the U.S. Global financial crisis, right? Or to let you time this war, that war, right? Those are not useful because they won't repeat, right? Those very large historical incidents don't repeat because people learn from history, and you want to take the part of the data that actually repeats. So, like you say, generally, sort of predicting geopolitics, those macro models, they don't work very well. Now, what is useful though is when you look at the data and you say, oh, occasionally, when you do have these geopolitical shock that you can't predict, but once you experience them and the financial markets react to them, can we say that you know our financial institutions and our investors tend to overreact to large geopolitical conflicts or underreact to them? That I have higher confidence because there are enough of those geopolitical shocks in different parts of the world to at least say, generally, do people overreact or underreact? And I would say the data says generally they tend to um, immediately underreact to how bad and how long it can get, and then afterward overreact to its impact on the financial markets. And so that at least we have enough data to broadly say post-event reaction.
Okay, we'll get back to geopolitical risks in just a minute because this is a fascinating topic, especially today. I have a question about data. I understand that you can probably collect some data about the US going back like 70 years. It will be more difficult if you go for the data for some European countries, which were not so brilliant in reporting their macroeconomics, to say the least. Nevertheless, when you look at emerging markets, their statistics can be, how do I put it, creative. How do you go about that?
Yeah, and so I'll talk a little bit both about data length and data quality. I'll kind of start with data length, right? I think one of the greatest mistakes for people who use the data science approach to do investing is, yes, statistically more data is better, right? Because we're all shooting for that T stat of 2, right? So for anyone who kind of knows what I'm talking about, yeah, you're all married to T stat of 2 because you took a lot of exams about it. But I would say in data, in at least data science as applied to investing, that's just a really bad idea because to get a high T stat, you just need a lot of data. And oftentimes when we get a lot of data, it's by extending it back historically, right? Because clearly you can't extend in the future. But the further back you extend, the less relevant that data is. So you're almost adding junk, adding noise, adding irrelevant data, just trying to juice higher statistical significance, and that's just a bad idea, right? That just sort of self-harming, right? You're getting a T-stat when that T-stat is no longer representative because you're adding data that's not relevant. So I think that's the one thing that I want to get super careful about because a lot of people pride themselves in being able to hand collect old data and extend the US back to the 1700s, right? Like, yay, that's hard work, but that is useless work. Um, so again, that's a bit about data length. But let me talk about data quality. Yes, you are right that emerging markets, um, you know, both, because US is on GAAP and emerging markets often are not on GAAP. They're on some other standard. And also just I think just the punishment, right, for an outright fraud is actually lower in emerging markets often versus say in the US, say in the UK, right? So yes, you are right to suspect that the data quality isn't great, but the good news about quant is like you kind of go into it and say, if the data quality were bad, right? Can I use quantitative techniques, forensic accounting to detect which companies have far worse data? And then you kind of know when someone gives you consistently bad data, it's not that they're trying to make themselves look less profitable, right? Generally, it's biased to the one side, right? They just want to make themselves look more profitable. So you're actually trying to detect sort of poor governance in the management team. And so this is kind of goes into governance as one of the most important factor and sort of quant models you can develop for understanding emerging market equities, right? If a company is detected to bad governance, those are great underweights that you can apply to your portfolio management.
But it's not only on the company level, right? It's also on a country level when some countries want to present lower inflation, high GDP growth, and you name it.
It's absolutely true, right? And so when you think about building country-based models, absolutely fascinating, right? Because by looking at just because all the governments have a tendency to underreport inflation because they want their central bankers to print more money, right? That's definitely
Of
good for
course.
everyone. Yeah.
Oh,
And they
sure.
yeah, and they want to hype up GDP to tell you that the current administration is more productive, is somehow more brilliant in managing the country. That's just true across the board for all of the countries. And you are right, emerging markets can tend to have a greater data manipulation. So in building country models, that's absolutely something we look at, right? How do you truly understand the inflation, right? And the greater deviation between what is the true inflation and what gets reported, there's greater amount of cheating, there's more monetary easing, more currency debasing than there is. And it gives you a great signal on trading against the currency in those countries.
Okay. Do you only trade stocks or fixed income as well?
We trade all the assets. We trade equities. So and we have single company models, but we also have sector level, the country level, and our country level models can be applied to sort of currency, country level credit, and then for countries that are resource rich, right? And their models that helps us understand kind of how to price raw materials, crude oils, gold, for example.
Okay, yeah, I get that. Currency, you mentioned currency. How do you go about hedging the currency risk?
So generally, we don't think about currency risk hedging. We think about, do we have a view on the currency? If we don't have a view on currency, we generally are happy to hold the asset in their natural currency because there's just a bit of a sort of natural sort of negative correlation between kind
Mhm.
of the asset value and the underlying currency. And so we don't mind that sort of natural currency diversification. So when we think about sort of currency, generally our models are much more about long-term currency value because what you do see is short-term currency. That's a bit about sort of understanding the geopolitics, but yeah, then that's a little bit more difficult. But long-term currency, you can at least look at the Asian currencies, right? You can predictably understand the trajectory of the currency strength by looking at the trajectory of the per capita GDP growth.
Yeah, sort of. But at the same time, you're speaking with a person who has experienced the Russian crisis of 1998. And I still remember, I'll probably never forget, how the ruble fell from 6 rubles per dollar to 24 rubles per dollar in a matter of 3 months. And you can have whatever long-term view you want to have. But and by the way, the correlation at that time wasn't so negative because the equity market collapsed at the same time.
Yeah, and so, doesn't matter how good your models are, and like you say, right, generally, I think we can build more sensible, longer term models that have long-term high predictability. What you can't get away from is the short term is generally unpredictable, right? Anyone who says they got great short-term models, look, that's impossible because you got great short-term models, you'd be minting money, you'd be richer than God very soon, and in equilibrium, we know that doesn't happen, right? So everyone's got to remember, it doesn't matter how high conviction of long-term model you have, right? It's about surviving the short term, and that's the risk management, right? It's like, if in 1998 you saw the internet bubble and NASDAQ was going to crash for 70%. Well, look, you know, that was true long term, but you probably, if you shorted the market, you couldn't last more than a year before you got blown up, right? Same thing with the subprime bubble, right? You knew that was insane, right? But if you short it going into it, you've been blown out way before the true price reveals himself. So, Igor, you're absolutely right in that the short term noise, first of all, you should just assume it's unpredictable so that you recognize it's a risk. And that is a risk that you got to manage for to get to the long run.
Okay, and this brings us back to geopolitics. The last several years have been quite interesting if you look at the geopolitical arena. I'm not only speaking about Russia, Ukraine, or U.S. Israel versus Iran. It's actually the changing of the overall geopolitical environment. We are moving from a unipolar system to a multipolar system, and this view was contested several years ago. Today, it seems like everyone is accepting it. In this environment, the geopolitical risks become even more important than before. Who would have known, for example, that the US investors would lose access to their assets they held in Russia? It wasn't just that those assets became cheaper. They did, but it doesn't matter. They simply lost access to it.
Yeah, it's quite funny. So in our EM portfolio, we actually had very significant stake in Gazprom, right? And of course, post the Russian Ukraine conflict, we are unable to sell that, right? It was forced by our custodian bank to mark it to zero. We can't sell it, so it just sits there. But we know it's very valuable today, right? You just look at oil prices, and Gazprom is one of the only game in town, right? And so you're right. Like I hold a very valuable asset. I can't sell it. I'm forced to market at zero, which create all sorts of issues for investors in the fund, right? Trying to get fair mark to market. So yeah, you're right. You wouldn't expect that. But it is part of reality, right? Like any investor on any given day could find their U.S. asset become unavailable and inaccessible to them if they have been labeled by the U.S. as a problematic person. But it goes both ways and always, right? Like different investors, depending on jurisdiction, could just lose access, lose valuation.
I would probably disagree with that. I certainly agree that there are two camps, and if you are a US investor, you are bearing additional risks when you are investing in a country like Russia or China or their satellite countries. If you are, let's say, a Chinese or Russian investor, then you are taking a similar risk, just a mirroring risk when you are investing in the US or in Western Europe, because your assets can be frozen
Yep,
overnight.
absolutely.
However, however, there is a third camp, which are non-aligned countries. For example, if you are based somewhere in the Emirates, and it's very unlikely that your assets in Russia or China or in the US or in the UK are going to be frozen because you are politically neutral.
So political neutral, right? So it almost forces you to kind of go, can I have shifts in alignment? Do I want to, you know, move away from neutrality, right? And that in itself, right, is both a threat, right, and a constraint. I would say, if you're, I would say, if for some whatever reason, right, like you were previously a neutral country, but all of a sudden you kind of go, I express sympathy with Iran, there could be repercussions, or I express sympathy, or somehow I see it as advantageous for my country to get in on some Russian oil trade. Then all of a sudden, sanction applies to you as well, right? So that neutrality can change.
Yeah, but you don't need to express sympathy. As an investor, you can simply use the opportunities which open up for you. Because let's consider the example of Russia. You can't invest in Russia. You can't buy any Russian stock right now.
Indeed.
Whatever value you assign to that stock, it doesn't really matter. You are just legally prohibited from doing that. If you sit in Emirates, you are an Emirati investor, you don't have that problem. And Russian assets are priced so cheaply now
I know.
that
It's an
it's like a
opportunity,
no-brainer. It's like a
a
no-brainer to
no-brainer.
buy
Yeah,
them. And you're not sympathizing, you're just making money.
that's right. No, and I agree, right? Like, if you're small enough to operate under the radar, I think these are great opportunities. Once there's sort of a nation level shift in alliances, you of course, could become collateral damage.
Okay. Uh, Now, when we speak about emerging markets, when we speak about geopolitics, we can't avoid speaking about China. Uh, this is the elephant in the room, like the global elephant. What place does it take in your portfolio, and how do you think about geopolitical risks which China is currently presenting?
Yeah, and so, I think, I wanna go to your example of, as investors, right? Like, we're not politicians, we generally are just looking out for an opportunity for our investors. So what we see, like in the G2 conflict, US-China conflict, we're not taking sides. We don't apply judgments, right? Because this is not an ESG portfolio. We're seeing, are there really cheap assets to be had because of the geopolitical conflict? So we were big buyers of China at the height of China is uninvestable, right? Because again, as a quantitative data scientist, I've seen in data, right, anytime an asset class, a country is uninvestable, right? Um, well, generally, if it's a major asset class, a major economy, they don't go away. It just means they have, short term, a lack of access to capital. So if things are very, very cheap, and if you're willing to be the person providing capital when no one wants to provide capital, they pay you really well. And that's what we do for our clients, right? We actually take them into markets where the sentiment is uninvestable, but when the true underlying asset quality, has global value, right? Like if you're buying someone who is a monopoly in China, and so they're minting money, and just because they're globally uninvestable, so they lose some, they have some flight of capital, their price is depressed. You kind of go, but I know the cash flow, I know the margin is there. If I can buy at half the price, why not? Right? It's like you look at Gazprom and you kind of go, that's not going away, and oil is twice the price as where it was when it got marked down to zero. That cheap asset is if I hold it, I'm going to collect a massive dividend, and at some point, if it reverts in value, I'm going to make on capital gains. So, for us, when China became uninvestable, it was particularly attractive for us because there's no reason to sort of believe that without foreign capital, China was going to go to nothing, right? Without foreign capital, Chinese assets becomes cheaper, but they're equally valuable and productive.
What role does China play in your overall portfolio? Is it a big exposure?
Yeah, in our kind of, a lot of people kind of size EM to the MSCI weights, and then and you know me, Igor, right? I never like the kind of cap weighted index way, right? Because that almost is, so pro-cyclical, and you miss out on any mean reversal possibility.
Yeah, because
So,
it's a trend following strategy.
yeah, it's a trend following strategy. So we have China at 50% of our EM, in part because at least a few years ago, when China was sort of got the least weight in MSCI was our big overweight. So I said think of generally you'll find China to be anywhere from 40% to 50% in our portfolio, and right now it's actually particularly interesting in the sense that the U.S. and China have sort of reached a very interesting agreement, which is, you know, U.S. will apply AI and capture its own market. China will be applying its AI to capture its own market, but their technology, right? They compete in outdoing each other in terms of cost efficiency, but they don't compete in markets, and that actually is a phenomenal outcome, right? Meaning these firms, right? Don't have a winner takes all, and so that risk of, hey, if the U.S. is got a breakthrough versus China, then the Chinese company be worth zero or vice versa. Now, regardless how they compete, they'll always own and capture their own domestic market, and those are massive markets. So it means China is just such a great diversifier. And then also, if you want to access the value that can be created from AI in China, you have to buy Chinese assets because it's like the market's sort of just carved off for them. So that makes it almost twice as attractive, right? Because that risk of losing in the AI race has gone to zero.
How big is the AI in your portfolio? Is it a big part?
Yeah.
So if it happens to be a bubble,
Yep. If it happens to be a bubble, we're gonna sort of ride down the bubble alongside everyone else. And our assessment right now is sort of AI is benefiting from a FOMO bubble, and we're probably still quite early, maybe inning four in this 9 inning baseball game. I know people hate it when we use American baseball analogy because who the hell plays baseball? But that's to say we're kind of halfway through, and that's because this is again looking at data, right? Looking back a bit, if you look at kind of the internet bubble, right? Uh, of course, if you held it long enough, right, and if you're a little bit more careful in picking your stocks, right, the internet created 20 plus years of just continuous, wealth compounding, except with that dip. And so the AI will do the same thing, right? Like that theme will continue to create value. You just got to sort of rebalance into the right name along the path. But in the short run, right? Like there are a lot of names that just the sentiment carries it completely out of whack, and so you want to rebalance against things that just have from a valuation perspective that's just completely silly. So if you do enough of that, sure, when the bubble bursts, you're gonna have to ride down with it, but you also don't want to miss kind of like a 30-year super cycle as well.
speaking about the share of China in your portfolio, you said it's about 40-50% of your portfolio. To be honest, it's a little bit surprising to me because I would have expected that since your mission is to bring capital into undercapitalized markets, China would probably not be the first one I would think about. I would think of some Latin American countries. I would think of some Southeast Asian countries. I would probably even think about Africa.
Yeah, so no, great observation. So we, were actually quite big in terms of an overweight into India. Now, as sort of the AI bull market really started to take shape, we rebalanced aggressively out of India, right? And we kind of rebalanced out of India at the height of the, India is the next China talk, right? When China became massively uninvestable, India was the next China. That was when we did the big rebalancing out of India into China. And so part of the reason was just sort of looking at India. Um, you know, for India to become China, it was going to take significantly more investments in infrastructure, and we just weren't seeing that happening. It's going to require significantly more of an ecosystem shift of manufacturing, all collectively move. But what we're seeing was sporadic, politically pressure move that was not going to amount to very much. And we weren't seeing India from a policy perspective, so rising up to really put in the industrial policy to create manufacturing. So that was part of what tempered our enthusiasm. And then when we saw AI and what we saw, wow, AI was immediately going to take back from India what India already took in terms of call center outsourcing, in terms of kind of software outsourcing on the SaaS side, and we actually thought the entire SaaS industry might go away. So then we became a big India underweight. So yes, broadly we love opportunities in emerging markets, but we're quite tactical and selective. I think we do love, but this liquidity is really the constraint. We do love the Middle East. We actually do think, you know, after after the Iran conflict, right? The amount of reconstruction in Iran, and I would say most of the Iran reconstruction funded by the other Emirate countries and any oil that needs to go through the Hormuz Strait, that is going to go toward a lot of Chinese construction companies. So we actually see a lot of the reconstruction of the Middle East as benefiting China, but also a long extended period of prosperity and peace in the region. I really do think the Abraham Accord is sort of going to see daylight. We believe in the Vision 2030. So we actually quite like that. Just the liquidity wise, we can't take a very large position.
Mm. Yeah, understood. This is not very strategic, though. You said that you don't try to predict short-term returns, but you're not speaking the next 20 years. You're speaking about next 1 to 3 years.
Well, I don't know when the conflict in the Middle East is going to ease. But I do have very high conviction that it is going to ease because I would say kind of the major power players, right, kind of can all live with the exit path, right? Um, you know, that China, I think, will continue to support the current Iran regime, and so it'll get a lot of business from rebuilding, and it'll have almost sort of greater access to Iran. The U.S., right? Weaken Iran enough, so I think there's a path to peace. Right? When and exact details I can't predict, but once we have peace, right? I do think it's not just a cyclical, not a 2 3 year. I see a secular. I see a decade plus, 2 decade plus of growth in the region.
Okay, you are very optimistic. Uh, I'm, to be honest, a little bit more skeptical about the situation around Israel and the whole Middle East situation. But anyway, that's the difference in opinions, right? Which creates inefficiencies. Speaking long term, and speaking about China, China faces major demographic problems. And nevertheless, you are quite bullish on China. Who's going to consume all that if there are less and less people there?
Yeah. So, I think the hope that, China, uh, its own domestic consumption becomes the key driver. I think, I don't believe in that thesis. Right. I mean, sure, it will increase for sure, but it won't increase big enough, right? So I think China will continue to be a manufacturing driven economy. It's transitioning to ever become Europe-like or US-like in terms of just consumption-led. I just don't think that's in the cards. So China may become more like a Germany, right, in the long run. So the demographics issue, right? I mean, the demographics issue for China, given that it is a manufacturing driven society, it's all about productivity. And the per capita productivity for China has to do with automation, has to do with highly skilled engineers, right? I don't think there's going to be a net decline in the number of engineers produced. I don't think there's going to be a net decline in the productivity of those engineers with AI, with robotics. Right? If you go to Chinese manufacturing, most of Chinese manufacturing is not about low cost workers. They actually have significantly more advanced factories, right? They have what's called a zero light factory, meaning because there are no humans working in there, they don't actually need light. Right? It's all just robots doing stuff, right? So they don't need the low cost labor to drive their manufacturing. They already sort of cross over that phase. And so the mass population in China is actually a net welfare stress on China, right? A lot of what we're worried about in China is like, there's actually quite a bit of local debt. Why do they have a lot of local debt? Well, because they're a very prosperous country, and so a lot of people actually haven't shared in the prosperity, so they become sort of the government's welfare state, right? Just like the U.S., like Europe, right? Just a lot of people who haven't participated in prosperity, they become sort of net burden to the government. So with the reduction in population and actually as a fraction, like high skill engineer become a larger fraction of population, it actually reduces social strain on the government's budget expenditure.
Now, let's speak about investors who are currently not yet invested in emerging markets. If we think about the trajectory and we think about the last, I don't know, 30, 35 years, the Berlin Wall, the collapse of the Soviet Union, bull market of the 90s, since then, the inefficiencies in the emerging markets have significantly, by the order of magnitude, reduced. Don't you think that it's a little bit too late to start now?
Ah, uh, so emerging markets have emerged a lot, right? If you look at Korea, Taiwan, now China, and then to some degree we've kind of seen, India even itself emerge a lot, and you kind of go, look, like the bulk of it has emerged, right?
Yeah, and
is
and you can look at other countries as well. You can look at Eastern European countries. Is Czech Republic an emerging country now? Is Poland an emerging country? Is Israel an emerging country?
Israel absolutely is not. So my point is when you look at how much emerging on the GDP side, on the per capita GDP side, you kind of go like, has the bulk of it happened already? We're just labeling them as emerging, but really the growth isn't there. So again, now this is where data is valuable, right? If you look at data, right, there's actually a very meaningful lag between kind of per capita GDP growth and stock market growth. The stock market growth actually lags very meaningfully. Well, yeah, we'll take Taiwan, take South Korea, take China example because those are where there's sort of longer and better data and in both cross section and longitudinal. What you see is initially the economy grow and the per capita GDP and labor income grow very, very meaningfully because of US outsourcing, right? So you kind of have US companies coming in, uh, setting up plans, teaching labor. And what you see is while per capita GDP grew, right, there's not much of a corporate sector, right? There's not a lot of companies. There's still state-owned enterprises. And the corporate profits were generated to what? They're generated to the American companies that have come to do outsourcing, right? And it's only
Mhm.
over time that the Chinese accumulate enough wealth, they start to set up their own company, and it goes from small to larger. And then as they sort of grow and compete and come into their own, then they start to have listed companies that are profitable that then you can invest in and that are not just a really low cost sort of OEM, but start to own some IP and eventually become like the Samsung, become like the TSMC. And so in China, you're just actually stepping into that phase, even though they have had like 20 plus years of really good GDP and per capita GDP growth. It's only now translating to enough sort of capital accumulation to build lasting and large enterprises. So there's a meaningful lag. So I don't think we quite sort of miss emerging market growth, at least on the corporate earnings side.
Okay, interesting. And if I ask you, what is the biggest misconception which investors have about emerging markets?
Yeah. So I think the biggest misconception is actually what we just touched on, which is a lot of you think you're going in there to buy GDP growth. That's just not true, right? Like yes, there's been a lot of GDP growth. You've seen a lot of GDP growth in Africa today, right? Across Southeast Asia, but you can't buy that, right? Not unless you want to go there and set up a store yourself, right? You
Don't
can't
you?
buy those. You should, but it's just a lot of work for most of us who grew up in the comfort of the Western developed world. We aren't quite cut out to go open up a store or factory in the emerging market. So how do we participate? We can only participate once those companies are big enough, become listed, and we can sort of buy into them. There's got to be some liquidity at least, right? And so you can't buy their GDP growth. You can only buy their corporate profit growth. And so that's a very different analysis, right? So it goes way beyond analyzing, their long-term policy, right? It goes, you actually have to spend time in understanding, the industry as it grows, understanding the companies. And so if most people don't realize, there's actually almost zero correlation between GDP growth of a country and the stock market performance. Okay, and so that's just really important for investors to understand, right? Because you can't buy emerging market GDP. You can only buy their companies. So it still goes down to analyzing and understanding their companies.
Well, you can buy emerging market debt, right? Which
Yes, that is much more correlated to their GDP. Yes.
yes, that's what I mean. Do you think it's a misconception which people believe that their rights as investors are not so well protected in many emerging countries?
So I can't speak for all of them. I can only speak for kind of ones where we have large active positions and we spend a lot of time sort of, both building the business there because not only are we investing there, we're out there gathering capital and oftentimes we're actually they're selling products. So I'll just because most people want to talk about China, so I might as well just talk about China. Um, and it's actually not a unique experience, right? I mean, my experience in Korea, in Taiwan, and previously in Japan, when Japan was much more emerging, was that they go out of the way to be very nice to American capital, to foreign capital, right? They just don't want to ever go into a fight because for them that's complicated. They don't know how to deal with that. They don't want to go to international court, right? They don't want bad press, right? Like if the city, the province has a fight with American company, maybe it goes to Beijing and they get in trouble for messing with national policy, making the country look bad. So they actually go out of the way to be really accommodating, really nice to you. And so I think they're far less nice with their own local people and local companies.
Well, that's the problem, right? Because you can't rely as an investor, especially as an institutional investor, you can't rely on someone wanting to be nice to you. You want to rely on the rule of law.
Uh, so yes, and that means they go out of the way to kind of really spill it out, and he asked for clarification, really clarify. And so in some ways, right, the rule of law, right, as stated, right, they stay far away from it to make it sort of non disputable. Right, so I would say like this belief that they don't respect their own laws or they have laws that don't make any sense. Um, I would say, and then like when it comes to foreign companies, that's generally not been my experience.
Interesting. As an emerging market investor, what has been your personal biggest mistake so far?
Yeah, so as a emerging market investor, both because we built the business in many of these emerging market locale, but also as sort of buying their listed securities. I'll kind of start with buying the listed security as a portfolio manager. The one thing that you often do underestimate is just the operational costs. So like, you know, the Chinese company, the Indian company, getting data and researching that is not the hard part. The hard part is, opening an account, right? Just the difficulty of opening up an account. And then the cash settlements, right? Because in US, we're generally, very comfortable with T+2. You can buy something and then make the cash ready. In those markets, South Korea, for example, India, for example, right? You got a pre-fund. And that means when you're doing rebalancing, if you're, selling out of Korea, it takes much longer to get your money back, and you can't have credit first to use. And then you got to pre-fund the position you're about to buy into India. So, there's just a lot of cash slippage, right? You're almost keeping too much cash around all the time just to work around these not very friendly settlement issues. So, if people want to complain about emerging markets, the biggest complaint is, I think unlike, US and then UK, like these markets are all sort of synchronized in these cash settlement and, pre-funding, that you could seamlessly rebalance across these markets with very low friction. That's just not true in emerging markets, right? Rotating out of Korea into Taiwan, Taiwan into India, the amount of friction, but not actually cost friction, but just like the time, right?
Mhm.
Means you also would have a lot more cash slippage. And that for an institutional portfolio manager, right? It's unacceptable with, to have that kind of cash slippage sitting in the account. So that's why I've been to the biggest rude awakening. So like simple things that we take for granted, that doesn't exist in emerging markets.
Yep, understand. And this sounds very familiar. All right, Jason, it's been a fascinating conversation. Thank you very much. Very interesting indeed.
Thanks, Igor. Always glad to be on your show.